America just lost 23,000 jobs, and Wall Street celebrated. Seriously. On Friday, the United States released one of the weakest jobs reports we've seen in quite a while. Economists were expecting the economy to add jobs. Instead, employers cut 23,000 of them. And if that wasn't bad enough, the government went back and looked at the previous 2 months and basically said, yeah, those numbers weren't as good as we originally told you either. May was revised down by 66,000 jobs. June was revised down by another 37,000. That means 103,000 jobs that we previously thought existed effectively disappeared from the numbers. So naturally, after receiving all of this wonderful economic news, investors did the only logical thing imaginable. They bought stocks. The S&P 500 climbed roughly 0.6% and closed at a record high. The Nasdaq jumped about 1.3%. Technology stocks rallied. Treasury yields fell. And if you are sitting there thinking, hold on, people are losing jobs and the stock market is hitting records, how does that make any sense? Good, because it shouldn't make sense. At least, not until you understand what Wall Street is actually betting on. And once you understand that, this entire market starts looking very different, because investors were not celebrating people losing their jobs. They were celebrating what those lost jobs might stop the Federal Reserve from doing next. And that difference is incredibly important. You see, most normal people look at the stock market as if it is some kind of scoreboard for the economy. Economy doing well, stocks go up. Economy doing badly, stocks go down. Very reasonable. Unfortunately, Wall Street has never agreed to be reasonable. The stock market is not really a scoreboard of what the economy looks like today. It is more like a giant, caffeinated betting machine trying to guess what the economy, corporate profits, inflation, and interest rates are going to look like 6 months, 12 months, maybe several years from now. And right now, one thing sits at the center of almost everything: interest rates. For the last several years, investors have become obsessed with the Federal Reserve. Fed speaks, markets move, inflation comes in slightly higher than expected. Markets move, inflation comes in slightly lower. Markets move. Someone at the Federal Reserve clears their throat during an interview. Some trader somewhere probably opens 17 Bloomberg terminals. And there is a reason for this obsession. Interest rates affect almost everything: mortgages, car loans, credit cards, business borrowing, government debt, and importantly for investors, the value they are willing to place on stocks. Imagine I give you two choices. You can put your money into a relatively safe government bond, paying you an attractive return. Or you can put that same money into a risky company whose profits may or may not arrive years into the future. When safe interest rates are high, that risky company has to look extremely attractive before you choose it. But when interest rates fall, suddenly those future profits start looking more valuable. This is one reason technology and other growth stocks can react so strongly when bond yields fall. And that brings us back to Friday. The jobs report came out. Minus 23,000. The bond market immediately started moving. The 10-year Treasury yield fell after the report. The 2-year yield, which is especially sensitive to expectations about Federal Reserve policy, fell as well. In other words, investors looked at the employment numbers and thought something like this: well, if the labor market is weakening, maybe the Federal Reserve doesn't need to make borrowing even more expensive right now. And stocks liked that idea. That is the strange world we are currently living in. Bad economic news can sometimes become good stock market news, but only under very specific conditions. And this is where things get interesting, because 23,000 lost jobs by itself is not actually the most worrying number in this report. The revisions may be more important. Originally, May was reported as gaining 129,000 jobs. That has now been revised down to 63,000. June was originally reported as gaining 57,000. That is now only 20,000. Then July comes along at negative 23,000. So don't just stare at 1 month. Look at the direction. 129,000 became 63,000. 57,000 became 20,000. And now we're below zero. Suddenly, the labor market looks much colder than it did just a few weeks ago, and there are other little warning lights flashing in the report. The labor force participation rate was 61.4%. Since January, that rate has fallen by 0.7 percentage point. That matters because the unemployment rate can occasionally give you a slightly confusing picture of the economy. The unemployment rate actually came in at 4.1%, and somebody might look at that and say, see, everything is fine. But unemployment only counts people who are actively participating in the labor force and looking for work. If someone stops looking altogether, they aren't necessarily counted as unemployed anymore. It's like trying to measure how many people failed an exam after some people stopped showing up to class. Technically, your failure rate might improve. That doesn't necessarily mean the students suddenly became geniuses. Now, this doesn't mean America has suddenly entered some catastrophic employment collapse. That's not what the report says. The Bureau of Labor Statistics itself described overall payroll employment as changing little in July. Healthcare still added around 22,000 jobs, but local government education lost about 50,000. Retail lost around 19,000. Financial activities continued trending lower. So what we are seeing is not an economy where every employer simultaneously turned off the lights and sent everybody home. It's something more subtle. Hiring momentum is weakening, and that puts the Federal Reserve in a very uncomfortable position. Because normally, weakening employment gives the Fed a fairly obvious response. Make money cheaper, lower rates, or at least stop increasing them. Give businesses more breathing room, make borrowing less painful, support economic activity, problem solved. Except there is another person sitting at the table, inflation. And inflation has apparently decided it would also like some attention. This is the real problem facing markets right now. The Federal Reserve has two major things it cares about: price stability and employment. If inflation is too hot, higher interest rates can help cool the economy. If employment becomes too weak, those same high interest rates can make the slowdown worse. So imagine driving a car where the engine is overheating, but you're also starting to run out of fuel. Do you slow down, speed up, pull over, or just stare at the dashboard and quietly regret buying the car? That is basically the Federal Reserve's situation. Inflation pressures mean policymakers cannot simply ignore prices. But weaker employment makes additional tightening more dangerous, and Wall Street is standing on the side of the road trying to guess which problem the Fed will worry about more. Friday's jobs report shifted that calculation. The weaker labor market gives the Fed more reason to be patient before raising rates again. That is what the stock market liked. But here's the part I would be paying attention to. There is a limit to how much bad economic news Wall Street can celebrate. A very big limit. Because stocks ultimately represent businesses, and businesses ultimately need customers. Customers need income. Income usually requires employment. You can celebrate weaker hiring because you think it will keep interest rates down. But if weaker hiring turns into layoffs, and layoffs reduce consumer spending, and weaker consumer spending hits corporate revenue, and corporate revenue hits profits, then suddenly the exact same bad news Wall Street was celebrating becomes actual bad news. There is a sweet spot investors are hoping for. The economy slows enough to reduce pressure on interest rates, but not enough to destroy corporate profits. Inflation cools, but not because consumers have completely run out of money. Hiring weakens, but unemployment doesn't explode. Essentially, Wall Street wants the economy to become slightly sick, just sick enough that the Federal Reserve brings medicine, but not sick enough that we need an ambulance. And historically, navigating that difference is not exactly easy. There's another reason stocks didn't collapse Friday. Corporate America has still been producing strong earnings. Nearly 90% of S&P 500 companies had reported their latest quarterly results by Friday, and overall profit growth has been strong. That matters. If companies are still making a lot of money, investors can look at one weak jobs report and say, okay, maybe growth is slowing, but businesses haven't fallen apart. So Friday wasn't simply bad jobs equals stocks go up. It was closer to bad jobs plus strong corporate profits equals maybe the Fed can wait without the economy falling into a hole. And investors like that combination, for now. But the next piece of this puzzle is inflation. Because if upcoming inflation data remains stubbornly high, things get complicated very quickly. Imagine the jobs market continues weakening, but inflation refuses to come down. Now the Fed has two bad choices: raise rates to fight inflation and risk making employment worse, or protect employment by keeping rates lower and risk allowing inflation to stay elevated. Neither option is particularly pleasant. And that is why this jobs report matters much more than whether the S&P 500 was green for one day. The market is making a bet. It's betting that America's economy can cool without breaking. It's betting that corporate profits can stay strong even as hiring slows. And it's betting that the Federal Reserve will have enough flexibility to avoid pushing the economy too far. Maybe that bet works. It absolutely could. But Friday showed us something fascinating about where investor psychology is right now. The economy produced a number that would normally sound terrible in a headline. America lost 23,000 jobs. The previous 2 months were revised down by another 103,000. And instead of panicking, investors pushed the S&P 500 to another record close. Not because losing jobs is good, not because Wall Street wants Americans unemployed, and not because the stock market has completely lost its mind. Okay, maybe we shouldn't rule that last one out entirely, but the real explanation is much simpler. Investors aren't trading today's economy. They're trading tomorrow's Federal Reserve. And right now, weaker jobs make another interest rate hike a little harder to justify. The danger is what happens if weakness continues. Because there is a point where bad news stops being good news. There is a point where investors stop asking, Will this make the Fed more friendly? And start asking, wait, are companies about to make less money? That line is what matters now. So don't just watch the stock market hitting records. Watch employment, watch inflation, watch bond yields, and most importantly, watch how the Federal Reserve reacts to all three. Because Wall Street is currently walking across a very narrow bridge. On one side is inflation, on the other side is economic weakness. And right now, investors seem convinced America can walk straight through the middle without falling off either side. Friday's record high tells us Wall Street still believes that story. The next few economic reports will tell us whether they're right.